Go in and talk about in the news. Now, again, for those of you brand new watching us in a new city, or those of you that are new here tonight, I like to try to either take one or two or three news stories and kind of break them down, go through the headlines and find out the things that are impacting and affecting those of us who are creative real estate investors, and try to get into some of the weeds and the things that maybe you missed if you were just looking at headlines. And this is one of those that kind of fits that category. There's a story behind the story which I like to try to get to. And the headline, and maybe you had seen it, this came across I think on CNBC or Forbes or somewhere, but the refinances over the last week or so hit a 20-year low, even though there was a dip in interest rates, okay? So we had a drop, a pretty decent drop in interest rates from the 30-year fixed, went from 4.84 down to 4.79. So normally, whenever we see a drop in interest rates, we see refinances starting to pick up. So why in the world with a drop in interest rates did we not see refinances pick up? Because everybody's already refinanced, right? Because this little bit of drop in interest rates doesn't matter. It's been as low as 3% something. So if somebody was going to refinance, they probably have already done it, right? And so these little nuances, these ups and downs that we're going to see, you're not going to see a lot of refinances. The fact that there is a 20-year low shows you that those who could refinance pretty much already have. And those that were bad debt and couldn't refinance, their houses have probably been lost and foreclosed on, and that capital has been redeployed to new borrowers who could put down a sufficient down payment and got the lower interest rate. And so, but what I wanted to dig into and kind of show you the story behind the story that I think is intriguing and interesting, specifically for those of you who are in the creative real estate investing space, which is what we primarily teach here, is that over half of all homeowners, and this is in your notes in the news, if you guys don't know, those of you that are in our licensee locations as well, you should have your notes in the Swine Times. How many of you guys don't have the notes? For whatever reason, you don't have notes in front of you. Look nearby. There should be probably an unused Swine Time sitting near you that will have the notes in it. So if you guys have one next to you, hand it to somebody who's got their hand up and doesn't have the notes. I want you guys to be able to follow along, especially when we get into the teaching. But I wanted to get into the story behind the story here and kind of point something out to you, is that over half of all homeowners, in fact, is pushing towards 60% of those who have a mortgage at less than 4%. Okay, so that is why when you see something even dropping, even if it went from 4.84 down to 4.2 or 4.1, you're not going to see a huge uptick in refinances, because basically everybody's pretty much got the best rate that we're going to get, and rates are only going to go where from here? They're going to have little dips, but obviously they're on their way up. Okay, so but the big point in that is, if almost virtually everybody out there with a mortgage has a mortgage at 4%, we're going to see a window at least over, and I know Jay Paul does quite a bit of this as well, and I've done quite a bit, and maybe some of you guys are in the market of subject to, but we're going to be in a market, right, over the next 1 to 3 years where it's going to be pretty good and right for some subject to, as some of these borrowers, if they do, get into motivated seller type situations where they need to move their property. Because obviously refinances were a little bit, I would say they were safer with those. They weren't doing 110% loan to value. So they're going to have usually about 20% of equity, and on top of that, amazing terms, 4% or less. And so if somebody does get into a situation where they're relocated or they've got to sell something quickly, and you're able to take it subject to over the next few years, that's certainly going to be a prime opportunity, to be something to focus on, to understand, and to use in your business, be able to leverage somebody else's loan in order to be able to purchase that property, have built-in equity, maybe not loads where you could make a cash offer and maybe get it, but enough equity to be able to take subject to and have really favorable terms in order to take that property and maybe sell it on lease option or rent it out. Okay, so that's something to consider. The other thing to consider is, over the next 3 to 5 years, understand you're going to start running head on into a lot of HELOCs and second mortgages, okay? Nobody's refinancing anymore because rates have gone up. So if they want to pull equity out of their property, there's another article I shared with you guys last month. There's like $5.8 trillion in tappable equity. Right now, borrowers are not getting it. They're still a little gun shy after the market crash. But eventually, we have short memories. We're going to start tapping that equity. And as we do, nobody's going to refinance to get that equity, because then it would take the whole of their mortgage and raise the rate. So they'll keep the low 3%, 4%, and they'll go out out and get a second and a HELOC. So this is just throwing in a little extra, a little tidbit on the negotiation front. You need to get good at how to negotiate when you run into a HELOC or a second mortgage if you're looking to take subject to. One of the things that I always ask them when I come in contact with a second mortgage or a HELOC on a subject to is I ask them what they used that second mortgage on. If they used it to fix up the house and now there's additional value in the house, maybe I'll take over those payments as well. But if they used it to buy a boat that they're taking with them when they move, I'm going to try to negotiate to get them to keep paying on the second mortgage while I take care of only paying on the first mortgage, right? Because now they see it as they got something of value. This is almost like a consumer loan, and you can get more aggressive with your negotiation on the second when they've got something of value with it. So make sure you just consider that. The other thing to consider is if you are going to get into the sub-2 business, which I know not everybody wants to do, is make sure you're legally protected. Okay, make sure that you've done the necessary steps, and I can't go in and teach the entire subject to course that we did a couple years ago all over again. But you do want to make sure that there's been notification made to the bank that you're taking over the property, etc., in case down the road banks start calling notes due. Now, we've heard that for a long time, and people have said, the banks will never call a note due. Banks don't call notes due, and Ron LeGrand has been teaching that for 30 years. How many of you have ever heard of Ron LeGrand? I don't know hardly anybody who has done more subject to deals than Ron LeGrand. But here's something to be cautioned about. Ever since Ron LeGrand has been teaching that banks will never call notes due, we have been in a declining rate environment. Okay, check out the graph in your notes or up here on the screen. Back in 1980, 1981, which was really when the big onslaught of all the, the infomercial type, we'll teach you how to buy real estate, no money down, blah, blah, blah. That stuff really got big in the late 70s and early 80s when interest rates under Carter and early under Reagan were so high, right? And because of that, you started having, you wanted to do owner financing or some kind of special financing because nobody wanted to go to a bank and pay 20% if I can get the homeowner to take less, right? So that's when owner financing took place and a lot of this creative stuff started happening. And that's when Ron LeGrand and a lot of these guys started teaching, and for the last, since 1981, for the last 35, 36, 37, almost 40 years, we've done nothing but go down, 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 down. Now, if you look at a cyclical history, I looked at it going all the way back to like the early 1900s, there are always these bottoms. And then when you hit these bottoms, they start going back up. And so for the last 40 years, why would a bank call a note due, right? So if you loaned out money at 10%, and somebody's paying on it, even if it's not the person you originally loaned it to, and now if you call that note due and get your money back, you can only re-rent it out or resell it out, right, remortgage it out for 8% or 7% or 6%, why would you do that, right? Or if you've got it at 6%, and now if you call that note due, you can only get 4% or 3% like we've getting recently. Why would you do that? If you're getting 6 or 7, why would you want to make a big fuss and call the note due? If the payment's coming in every month, you just leave it alone, right? That could change very, very quickly. And the whole Ron LeGrand banks never call notes due and haven't for the last 40 years, and so they'll never do it strategy might stop when rates start doing this. Right? Now, we don't know what they'll do. They could just flatline. They could be at 6 till all of us die, right? But we don't know that. And so the reality is, as it starts to head up, you want to make sure you're protected, because I would not be surprised if we start hearing more stories of banks calling notes due if they think they can get that capital and redeploy it at a higher interest rate if rates have risen. Okay? So anyway, just keep that in mind. It's a story behind the story. It's just something to pay attention to.